We're
Yeah,
about to get started
it
as
is.
well. We got 2 o'clock now, but I'll just give a little introduction. But first of all, I want to thank you guys for joining us for the first Tax Talk Live event of the year. He needs an introduction, but I'll give it 1 minute anyway. We have Mr. Bill Delaney, our resident Tax Talk guru. Been in practice for 72 years, and hey, he's been a member since 1982. And coming February 1st, it's actually going to be his 43rd anniversary with NSA. So we really appreciate that from you. So yeah, just before we get started, I'd like to introduce myself. I'm Kenny Barleycorn. I'm the education manager with NSA. And as well, if you'd like to appear on screen, feel free to accept my invitation or ask me to send you one again. And then you should be able to appear on screen and also speak if you'd like to, whenever we catch a break. Please feel free as well to enter questions into the chat and the Q&A or communicate with each other. Just before we get started, I'd like to give a little shout out. Please don't forget to take advantage of this opportunity that we have to actually be able to earn the ATP, the Accredited Tax Preparer credential from ACAT. As an NSA member, you can actually do that for free for a limited amount of time. And if you have staff that's actually interested, I'll be dropping a link in the chat and they can complete the exam for only $25 until April 1st. So yeah, there's also an email that you guys got that went to your inbox yesterday. But please feel free to check up on that. And let me just drop that in the chat now. There we go. So with that said, this current session of Tax Talk Live will actually be on retirement contributions mainly. Feel free to ask questions, see where the conversation takes us. Just to get things started and get the wheels turning. So Bill, I just wanted to ask, assuming that you're in charge of all the tax laws and policies, what are some things that you'd like to see in the upcoming tax season and year?
Well, my big problem is the delay in refunds and the IRS's identity check. We can't help our clients. They have to do that themselves. It delays everything. Now you'll say, well, gee, it's necessary. I don't know how necessary it really is. You file a tax return, you claim a refund. Why can't you receive the damn refund? I mean, I have a case right now, and this is a little bit different from the norm, where there was an NOL carryback. The carryback originated in 2019 during the height of COVID. So it went back to 2014. Two of those refund years are still open. They haven't refunded the money yet. And
Worry.
you can't reach anybody who can give you an answer. You know, if you look at the IRS website, where's my refund? If the refund isn't in process, it isn't in process. If you call the tax preparer hotline and ask them to help you, they can't see any more than I can see. So it's a waste of time. Actually, one prior commissioner said that. He said, don't be calling the hotline because they can't see anything more than you do. You're wasting their time. So that's one thing I'd like to see improved.
That's valid. Yeah, I mean, the commissioner spot just opened up, so maybe they'll call on you.
Yeah, the commissioner claims everything has been improved, and maybe he's right. But this is one thing that to me seems to need fixing.
Mhm.
And I have a question for the general public here. I understand that multi-factor authorization is now a requirement. Is that so? And have you all gone through the process? I haven't.
Yeah, everyone feel free to jump in either via the chat or if you want to just unmute yourself, please feel free to answer how you guys have been dealing with multi-factor authentication and whether you're getting started on that process.
So This is Nancy. I last year went with a Yubico key that is being used by Drake Software. That's where I first heard of it. And it works beautifully, so I don't have to depend upon third-party applications. I can have the authentication on my computer, receive the key, type it in, and go on. So nobody else, it's not floating out there, and I don't have to get my telephone or whatever to work. It works on my computer.
Very convenient.
Well, I also have Drake, and I opted out because I didn't think it was a requirement. Now I've discovered that apparently it is a requirement. And you're saying, well, gee, use the Drake process. It's easy.
It can be used on multiple computers. Basically, when you go to set it up, you download the software for the authentication, and it gives you this QR code. So you tell the authentication to scan the QR code, and then after it has it, I pull it out and I do multiple keys so that if I were to lose one, I have another one, I haven't lost any, but and if you have multiple computers too, so you might want to put it on, you can put it on multiple computers as a user or something. But I like it. I don't have to depend on anybody, and I'm internal. So that's my reasoning.
Okay, thank you.
Yeah, thank you very much, Nancy. Yeah, and if you did you have any other else that you want to say, Bill, or can we move on to the next question?
Let me get my notes here.
Yeah, of course.
We had a conversation recently on Tax Talk regarding announcement 2025-2, and it has to do with minimum distributions and whether or not they're required for 2025 as a result of the Secures Act. And while the Secures Act says, yeah, they are required as of January 1, this announcement seems to say maybe. I don't understand the language here. I'll read this to you. In response to concerns raised by commentators, the provisions of future regulations are anticipated to apply beginning in the 2026 distribution calendar year. For periods before the applicability date, taxpayers must apply, and this is what I don't understand, a reasonable, good faith interpretation of the statutory provisions underlying the amendments. To me, that's gobbledygook. Is it required or is it not?
Anyone have any input out there?
Nobody seems to have an answer for it.
I think it's required, and I agree that it's gobbledygook. Is that what that, did I say that right? I think it's they didn't tell us soon enough what we have to do, so they're saying you got to do something, but just as long as it's reasonable. As long as you can come up with some kind of rationale for what you're taking out, I think they're saying that they're going to leave us alone and they won't penalize us. But not doing anything isn't reasonable. I think that's what they're saying.
Mm-hmm.
Yeah, thank you so much for that, Mark. And yeah, that did seem like the proper scientific term that you used there. But okay. So I guess I don't claim any tax expertise whatsoever, but we did have a question in terms of seeking a lower threshold and whatnot. So it said, with some lower thresholds for reporting, how are you handling Form 1099-Ks that your client might receive for personal transactions during the year? So, Bill, if you'd like to get us started, if you have any input on that, or we could pass it on to the rest of the
Will you
panel.
repeat the question? I'm hard of hearing, so oftentimes I miss words.
Mhm. Yeah, of course. Oh, and we'll get to you, Kelly. I'll just repeat the question. So, with some lower thresholds for reporting, how are you handling Form 1099-Ks that your client might receive for personal transactions during the year?
Well, what is there to handle? I don't understand the question. How am I handling?
Form 1099-Ks.
Yeah.
Mhm.
Oh, 1099-Ks.
Yeah. Mhm.
Quite frankly, I think I'm going to ignore them because I'm never going to be able to tie them in. And 1099-Ks are supposed to be formulated one way, but the issuers do different things. As an example, if there's some kind of deduction or commission associated with the payment, do you report gross or net? Well, you're supposed to, as I understand it, report gross. The problem for me is I get my clients' bank statements in order to determine the income. And that deposit on that bank statement is net. So if I don't get a 1099-K, I don't know that that particular entry has to be grossed up. So rather than go through all this, maybe not, I'm ignoring the damn thing. If the IRS wants to audit, we're reporting all of the income. And if they want it grossed up and then you deduct the commission somewhere else, fine. We'll gross it up, deduct commissions somewhere else, and still come down to the same taxable income. So as long as I'm reporting the proper taxable income, I'm not going to concern myself with that particular detail, drive myself crazy, and cause the client fee to increase for nothing.
Yeah. Okay, thank you for that. And Kelly, you had your hand up. Did you want to add anything onto that?
Yeah, I mean, the only thing I would say, I mean, the 1099-K issue that's going to come up, Bill, is that people are going to get 1099-Ks that are personal, and they've updated Schedule 1, so now you can put on Schedule 1 and information doesn't get added into income, but it just informational only on Schedule 1 that says, you know, I got a $5,000 1099-K when I sold my car. It was a personal sale. It's not reportable in income, but here it is because the IRS is they're going to do their CP 2000 kind of check, right? And do information checking to try and automatically reconcile or systemically reconcile the 1099-K back to the return. So it's my piece on 1099-K that I think is going to be fascinating, so to speak, is, and I asked the IRS to give us the data and they just kind of laughed and they're not going to share it. I told them, I want to know how many dependents out there that didn't file last year or 23 and now end up filing a tax return in 24 because they're getting all kinds of payments for all these side hustles as high schoolers and college kids, right? They're babysitting, they're dog walking, they're mowing grass, they're doing a whole bunch of things and they're getting paid on Cash App, a lot of them. So I think there's, you know, a lot of that underground economy is going to pop up.
Mm. Yeah, thank you, Kelly. That's really good to know.
One
Yes.
thing, didn't I read though that they're not supposed to issue the 1099-Ks for personal accounts, like with the Cash App and everything?
Yeah, but yeah, yes, you're right. I mean, if it's defined right, but it's, I guess what I'm going to anticipate, and in talking with a lot of different folks, so Junior's out there with a side hustle. He gets paid on a Cash App. It's linked to mom and dad's account. Now, mom and dad, one of them get a 1099, right?
But Junior's Cash App is set up as like friends and family, not.
Sure. Yeah. And I guess your point is, I mean, I think it has to be on our radar. It's it's going to
Oh,
be
definitely.
reported. It's going to be reported all over the map, right? And everywhere from kids with side hustles that should have been reporting income that haven't because I'm a college kid getting paid, quote, basically in cash. It's not income. Well, yeah, it is. To, it's tied to mom and dad's social security number. To, I mean, it's it's going to be entertaining. It's going to be very frustrating in 16 months, right? Or
Yeah,
12 when it
letters
starts
come in.
hitting when it all starts hitting the fan.
Mhm.
And I guess that's just kind of leaning in. I guess my observation is kind of leaning into clients that are probably not paying attention to the 1099Ks. And Junior gets one and he doesn't do anything. He doesn't file a return because he doesn't have a W-2, and he's going to get a CP 2000, and we're going to be talking to him in, this fall. It's going to be a challenge. And the threshold this year, previously it was 20,000 transactions, or 200 transactions, $20,000. The law is $600. And then they got administrative relief this year for $5,000 threshold, no transaction limit, just $5,000. And then somebody correct me if I think, does it step down again, or does it go straight to 600 in 2025? I can't
remember either.
I can't recall. But companies are out there, just like we've seen, I think, in the past, as people have issued 1099Ks for, $800 or, something even under, they just issue them, right? It's all electronic, just push them out.
Yeah.
Mhm.
So it's just another dynamic headache. I mean, I understand why they're doing it, but it's going to create some administrative nightmare for us. And I think some clients are going to have to be nudged and, make them think a little bit different, especially when it comes to kind of dependence, right?
Yeah.
Do
Sounds
you
like they've
think-
made your lives
Do
easier.
you think that if the IRS believes that this is business income and should be reported on Schedule C, do you believe they'll actually find it if it's reported somewhere else?
Well, the theory should be hang with me, Bill, right? So, I mean, the theory, the math should be the computer in Martinsburg or Detroit, wherever they push the work to, is going to add up all those 1099Ks and look to that source social security number for that gross income to be reported somewhere. And what fields they pull up and compare, who knows what that's going to be, but basically the same thing they've been doing with 1099, miscellaneous or rent or any of those in the past. And the computer's going to set up there and do its own thing and compute it. And if they get a social security number that has $3,800 associated with it and no return reflecting that, the computer's going to send a letter out. Right? They're going to send a CP 2000, and the client's going to come in and go, Junior got this letter. What's going on? And kind of, here we go. I mean, they're not going to send a revenue agent out on it, not for $3,800, but
That's
they're
what I
gonna-
think the value to the IRS is, identifying people who should file and aren't filing. But if you're already filing, I don't see how they're going to be able to track it. And that's why I said what I said. I'm not going to drive myself crazy over this damn thing.
Yeah, I don't know that I'd go crazy. I think it's the side hustles. I mean, I had a friend of mine a month ago talking to me in church, and we start chatting. He's an engineer, but he does irrigation kind of maintenance on the side because he used to be in that business. And so somebody will call him, it's like, oh, you know how to fix my valves and get my sprinklers working. And he'll go over and, swing by after work or on the weekend and help somebody out, and they pay him. So we're chatting about it, and I don't know how much money he gets. I didn't ask that question. And I'm like, well, so you're getting paid through PayPal, et cetera. And he's like, yeah. And I said, well, you're going to get a 1099K. And he gives me the look of, I don't report that income, right? That's the look you get, right? And he goes, well, seems like I'm going to get paid in cash going forward. And I'm like, oh, no, I mean, but that's the $600-700 million or $600 or $700 billion the IRS is looking for, right?
Yeah,
Um,
yeah.
so it's that underground economy or the tax gap, right? So it's going to be interesting. I don't know.
Yeah, for sure. By the way, Susan Cartmill did say that it steps down to 2K for tax year 2025 and then 600 for 2026. So,
Okay.
just letting y'all know. But yeah, thank you guys for your contributions to that discussion. So I guess just to more specifically go with the retirement contribution stuff. So Bill, what do you think most tax professionals should be considering when it comes to clients making retirement contributions?
Well, first of all, I think everyone should set aside some money for retirement. The problem I always run into is you can't convince young people that they should set money aside. And by the time they decide that, well, maybe it's a good idea to set money aside, they're in their 50s. And it's hard for them to set enough money aside so that they can retire. So fine, if your employer offers some kind of a retirement plan, you're stupid not to participate. And in my opinion, you're equally stupid if you don't make some kind of a voluntary contribution and just leave whatever the employer gives you in the account without adding some of your own money. I've never found a way to be able to convince young people that they should do this. And then you get a situation where, well, yeah, I know I should do it, but I'd rather do something else with my money. I always have counseled in the past my business clients. This is the first thing you think about once you have some spare money, once you can actually afford to do something. Set something aside, plan for the future. You get into a situation in retirement where maybe you don't need it or don't need it all. Well, isn't that a good situation to begin? Why would you not want to have that situation? Mary and I discovered after Mary retired and I cut back that our income was more than it was when we were both working. Because you get a pension, you get Social Security, you get RMDs, you have investment income. You didn't have that kind of stuff when you were working. You just had two salaries. That's what I tried to drive home for people.
If it's different generation though, Bill, that's the problem.
Yeah.
I mean, you have some people well, maybe a few people on this phone call, maybe one being the facilitator, their perspective is different, right? In that a lot of them see and go, I'm never going to be able to retire. I'm always going to work. So that's why I'm going to punch out of the workforce for 3 years and go wander around Europe, and I'll come back and I'll get a job and do my thing. And don't ask them to work. This is not the facilitator, right? Don't ask them to work overtime or work extra because they're going to punch in their 40 hours a week and be gone. And it's a different, and you're a generation behind most everybody on the call, right? I mean, so it's just a different perspective. But I agree with you. I'm not saying they shouldn't be saving because there's no defined benefit plans out there anymore to speak of. So if you don't save for yourself, I don't know. It's a problem. Or they're waiting for mom and dad to die and just retire on their money because Bill scrimped and saved and scrimped and saved. And so when you chuck it all in, Bill, your kids are going to be going like, thanks, Dad. Now we can retire on your money.
That's what we're looking at. Not so much the kids, but the grandchildren.
Right.
We just helped our oldest grandchildren buy a house rather than the condo, because the condos were higher in price than the house. And we were able to give her a substantial sum of money so that what she pays in the mortgage was a little less than what she was paying for rent. So she can afford this nice house. Yeah. The thing that I've also discovered is once you're able to convince someone to pay something into retirement, they continue to do that, and they get accustomed to living on the lower net income. And it doesn't bother them once you can get them into the system. My problem, as Marcus pointed out, is getting that generation to think the way you do and getting them into the system. As far as what a maximum amount is concerned, I don't have a clue. I find that whenever I'm confronted with what's the maximum problem, the investment advisor should be able to do that. Because if I go to something, I don't know whether what I'm looking at is really current or whether there's something else I should be looking at in addition. Because I see so few situations over the years where anybody is even approaching a max. That's a lot of money. How the hell, if you're making, according to your Schedule C, $70,000, can you contribute or afford to contribute 50 of the 70? You're damn lucky to be able to contribute 7 of the 70. What are you living on? So if I see that kind of situation, I wonder, what is it that they're not telling me? Where's the money coming from to live?
Mhm.
I remember asking that question one time in that kind of a situation, and the wife broke out in tears. And the reason she did is because her husband was lying to me. And she couldn't stand it any longer. So I don't see maximums. My problem is trying to convince people to put in that minimum and build it up. And I don't know how to deal with the young people who just can't see it. I'm trying to convince my oldest granddaughter, the one we just helped, to put some money into a Roth each year. She has a six-figure income. You think she'd do it? No, she puts it in a savings account.
Wow.
Ah, she's saving it, but I'd like to have her save some of it in a Roth.
You'd think she'd listen to, her grandpa, who's a professional, but
Her mother's worked on her too, and her mother's an actuary. And Anne can't pound it into Catherine either.
well, maybe one day you guys will get through to her. And
Yeah.
I guess that kind of leads into another question that I'd had, and I guess this is more of a general question, since you guys clearly have concerns and frustrations with that, because it's not a great situation. How would you best counsel clients in terms of contributing towards retirement, or what factors help you best determine what guidance to give them in order to maximize that, whatever they can give? And I mean, Marion Katz actually already gave in a sort of answer, and she said that when he was a teenager, I was able to get my son to start saving when I could show him it would make him a millionaire. When 5% didn't work in my calculation, I raised it to 7%. Demonstrated annual contributions would get him to millionaire status. He's now 37, and he maxes out all retirement opportunities, which amazing job with your son there, Ms. Katz. That's really good. But yeah, wonder if
So-
anyone had any strategies for that.
So is he working?
Yeah, I imagine he probably is if he's got millionaire status, but maybe there's something.
Well, assume he's working and he's a saver,
Mhm.
but he's not diverting any of that savings into a retirement plan, either a Roth or a deductible. And maybe the way to go with him is to show him how much money he would save if he took 3 or 4,000 of that savings and paid it into a traditional IRA, he would get a deduction. The approach I've sometimes used is if you pay $4,000 into the traditional IRA, the IRS is going to add $1,000 to that because you're going to get a tax savings, which you can then add to your savings if you want to once you get that refund check. So you're really saving 5 and it's only costing you 4. Isn't that a good deal? That has worked for some people. Gets them to think, well, yeah, the IRS is giving me a break.
Mhm. Yeah, and just to clarify, Mrs. Katz's son is already just doing that, and he's done a really good job with that. But it sounds like you're along the similar line where you demonstrate how much money this can actually be making you and saving you over time. So that sounds like a pretty good way to put solid, substantial numbers in front of somebody. Does anyone else have any other kind of ideas in terms of ideas for how they could maximize that or what to even get them started on that journey?
I think we all have the same problem.
Yeah. I'm sorry, we're broke as a generation. But
You know, I never, when I was employed for 20 years before I converted my little part-time practice to full-time.
mhm.
I was never employed in a company which offered a retirement plan or a defined benefit plan. I had to save it myself. And the issue for me and my generation is that tax rates were considerably higher than they are now. The tax on unearned income could ratchet up as high as 70%, and then you paid the state tax on top of that. So there was a disincentive in my generation for savings because the government would take it all the interest
Mhm.
between federal tax, state tax, and inflation, because there was inflation in those days. You'd lose 95% of your earnings. So why save?
Yeah.
Today it's different. Today the income tax is much lower. Today you actually can set aside some interest income and your savings account grows and you're not paying an enormous amount of tax on it.
Mhm. Hmm. That makes a lot of sense. But yeah, okay.
might-
Hmm?
Go ahead, Neil.
Oh, sorry, yeah. But yeah, I guess moving on then. So what are considerations tax professionals should pay attention to in regards to the 2.0, Secure 2.0 Act?
Are you
Yeah.
directing that question to me?
Yeah, we'll start with you.
Say it again. I didn't catch
Yeah.
it all. I'm sorry.
Yeah. What are considerations tax professionals should pay attention to in regards to the Secure 2.0 Act?
My notes here.
Yeah, that's valid.
What the heck is that? How many pieces of paper?
Oh, yeah,
Okay.
you'll find it. Did you want to give open it to the crowd in the meantime while you find that, or? Oh,
Well,
sounds-
this isn't necessarily secures, but it's the same. It's one of the secures provisions.
Mhm.
I'm looking at the regulations 1.5 401, parentheses, small a, parentheses, 9, dash 5. I can't believe some of these numbers. Retired minimum distributions from defined contribution plans. First of all, the employer's first distribution calendar year is the year that the employee attains the applicable age. Now, that's a change from where we were only a couple of years ago, where we had to deal with the 70 and a half or 72 or whatever it was. And are you required to make a distribution in that year, or is the required year the following year? Well, that's cleared up now. The employee's first distribution calendar year is the year the employee attains the applicable age. So if the employee attains the applicable age in December, that's the year for the minimum requirement. If he attains the applicable year, applicable age in January of that year, that's the year. You don't have this complicated counting the number of days. My wife's birthday is July 3. That seems to me, under the old rules, to put her into the RMD requirement in the year she turned 70 and a half. But when you count the number of days, it doesn't. Her requirement was the following year. Now, all that stuff has been cleared up, and it's very easy now to determine the applicable year. Now, when you're determining the required minimum distribution, for this purpose, all of the employees' accounts under the plan are aggregated. Thus, all separate accounts are aggregated for the purpose of this section. You have to put everything together. Some people seem to think that, oh, well, it's only for this plan, or it's only for that plan. It isn't for all plans. And you end up with a RMD that's below what you should have been taking. And we see this on a regular basis, at least I do, because I have an older client base. And I'm glad that it's no longer a terrible chore for me to determine whether they're over or under.
Mhm. Yeah. Okay, that makes a lot of sense. Thank you. I say that. I'm sure everyone else understood that. But yeah, does anyone else have any other input or considerations on that topic in terms of the Secure 2.0 Act and what you guys feel should be paid attention to? Oh, who is that? Oh, Randy. Yeah. If you could get a little closer to your mic, that'd probably help as well. We're having a bit of trouble hearing you, if I'm gonna be honest. Oop. Yeah. Feel free to contribute in the chat as well. That might be more conducive.
All right.
Oh, I heard you very clearly just then.
Oh, okay.
Yeah, there you go.
The Secure 2.0. When there's when the employee contributes to Roth 401k,
You are breaking up. It, yeah, I'm sorry, Miss Lindquist. It might be better to type in the chat. It seems like,
I'm gonna do that now.
thank you so much. Yeah, I'll read out your response once that comes through. Now, but okay. Did anyone else have anything else? All right.
I have a couple of things
Ooh.
outside of retirement and the Secures Act.
Yeah, for sure. Feel free to go on that while Miss Lindquist is getting her response out or figuring out her technical issues.
Well, I don't know how many of you have to deal with state paid family and medical leave and the deduction from employers to fund it. More and more states seem to be adapting this. And there seems to be a dispute as to whether or not any payments from this fund to the employee are taxable income, or is it some kind of a non-taxed benefit or something?
Hmm.
There was a chief counsel's advisory on this matter going back, must be 15 years. But the IRS has now issued a clarification. Let's see, what is the reference here? IRS ruling. Oh, Rev ruling 2025-4. And what the IRS has said is that if you personally must make a matching contribution, this is considered to be a tax. And it can be deducted for what it's worth as an itemized deduction on your federal Schedule A if you file a federal Schedule A.
Hmm.
If, however, you don't deduct it because you can't, or you choose not to, then it becomes basis in any money that's paid out to you. That's small change. The big issue is whether that money that's paid out to you is taxable. And in the revenue ruling, the IRS has said amounts paid to the employee by the state as a medical leave benefit and if this portion is attributed to the employee's contribution, that's excluded from income. Amounts attributed to the employer's contribution, in other words, the bulk of the money, is generally included in the employee's gross income under Code Section 105. And the state must comply with the employment tax and reporting requirements under Code Section 32 and other guidance. I've heard around here, meaning my state, from several people that, no, this isn't taxable. This is a medical benefit. And according to the revenue ruling, that ain't so.
Hmm.
It's taxable income. I've only seen a couple of payments. And I think this is an issue that's going to grow as more and more states adopt this.
Okay. Yeah. Was that your complete thought, Mr. Delaney?
The other thought,
Oh,
It's-
no. Oh, yeah, go ahead. Yeah. Mhm.
well, the other thought is lengthy and maybe we don't want to spend the time on it, but it happens to be on worker classification and whether or not you're an employee or a self-employed person.
Yeah, we'll see if perhaps that's something that we can get in towards the
That
end or
perhaps should be left for another day.
Yeah, that's totally fine. And in terms of considerations for the Security 2.0 Act, Rondi said WT reports and E/EE's Roth contributions, but then there's a 1099-R involved as well somehow. I think it may have to do with the employer's match. Evan then responded to that 1099-R is for the ER match amount only, provided they actually offer this and the match goes into the Roth. So there was some response there further in terms of Security 2.0 considerations.
If I understand her question correctly, she's talking about the 1099-R when a payment is made. And is she asking whether the employee's contribution should be excluded from the amount reporting on the 1099-R? Is that the question, Rondi?
Yes, she said yes. Mhm.
Yeah. You exclude that by going to the calculation. Most of our softwares have the calculation. It's also in the IRS instruction booklet, whereby you're allowed to amortize the employee's contribution amount over a period of years based on age. In the past, and it's the distant past, what you were allowed to do is exclude from the 1099 gross income any amount of employee contribution up to the total 1099-R. In other words, you get back contribution first. And then it was all taxable. The rule is now, and it's been in place for a good 20 years, that you recover your cost over time. If you die before recovering all of your costs, you're allowed to recover the balance on the tax return for the year of death. But the 1099-R is always gross. I don't know whether that answers the question or not.
Yeah, and I guess while she's potentially responding to that, she also said, I'm assuming that then increases the employee's basis. Would that be shown on the Roth screen in Drake? Any idea? Which I guess would be better directed to someone who actually uses Drake.
Roth screen, did she say?
Yeah, the Roth
Are we
screen in
talking
Drake.
about a Roth distribution?
Yeah, because I guess this is like based on the matching and if that go into like the Roth and whatnot, is what I'm assuming from the question and how it's been answered. But she's basically asking whether anything that then increases the employee's basis, like whether that an increase in the basis would be shown in the Roth screen in the tax software Drake.
Oh, okay.
Yeah. Okay. Anyone have any ideas about that?
I don't know, and I don't know why it would be necessary, because if you qualify, the Roth income is 100% tax-free. It's excluded. No, it shouldn't be. I shouldn't say it's excluded. Let's say, is it an exclusion or not? Is a 1099-R issue for Roth? Yeah, I
Oh.
guess it is.
Yeah,
So it's exempt.
It,
Oh, wait a minute.
it's
Let me
exempt
get it.
from
No, it's
employment
let's see.
tax.
There's a difference between exempt and exclude. It's exempt from tax,
No,
the entire
No.
amount. So it doesn't matter whether you have a basis or not.
it matters if you take it out early.
Oh, well, if you take it out early, that's a different question. I'm talking about a normal distribution.
I don't know if this helps at all or clarifies anything, but she did say, let me rephrase this. So many questions. The 1099-R is the employer's Roth match. One, is that taxable to the E/EE?
it is. It's taxable in the current year income unless they had money withheld. That's when the employer would have filed a 945 report. I've just gone through this because I had put out that question in the tax blogs. So the 1099 reports the income because it should be taxable to the taxpayer in the current year. The W-2 should have an AA in, I think, box 14, I think, or something that says that's the employee contribution. So all of it goes into the Roth and should all be non-taxable. So I would think possibly two things. Yes, it would get reported in the 8606, but it's also being labeled on the tax information documents to be noted. Okay, so you have two things going on. The Roth is restricted to the time frame that has that 5-year limit. Okay, so if you take it out, yes, it becomes penalized. But as far as that goes, it's kind of a neat program. It really is, but it took a while. It took about 1.5 years to figure this out and how to report it.
Oh,
Hope that helps.
thank you, Nancy. That seemed like a very comprehensive answer. Anyone have any questions or input about given topic?
Just to add to that, the 8606 would probably only apply if it was a Roth Simple or Roth SEP IRA. If it's part of like a regular 401k, that wouldn't appear on the 8606. But yes, it is confusing because there's the 1099-R, but it should only be subject to income tax. There's no penalty or anything. I believe there's a code G perhaps that it has that would sort of indicate that this is sort of the matching contribution.
Cool. Yeah, thank you, Evan. Anyone else?
Well, I'd just like a clarification from my own feeble mind. We're talking now about a Roth distribution which doesn't qualify to be excluded, exempted from income.
So this is the employer issuing a 1099-R for the amount that they've contributed to the Roth retirement account of the employee. In lieu of that always being in the tax deferred account, if they're putting it in the Roth account, that becomes essentially income to the employee. I see you processing.
Yeah, you're saying that this 1099-R is for an amount which was contributed by either the employee or the employer, And I've always understood that a 1099-R is only for money that's paid out.
So
So
this was
that's
one of
what's
those,
confusing me.
yeah, so this was one of those unique Secure 2.0 Act items, I think. So that's why it's a relatively new thing that has come out, and there's not a lot of people are seeing it, so it's not
No, I
overly
don't, I haven't
common.
seen it.
Yeah.
You can consider, if it helps any to grab the concept, consider it as allowing a rollover, because that's what the code G
Sure.
is about. It's a rollover. So they're letting you bypass the transactions and rollovers. They're letting you put it directly, but coding it as a rollover, which makes it taxable in the current year as income taxable. Does that help? Sorry, no.
This,
It was good for me.
see, this is the time when I feel my ears. Because I can't process this concept. We're taking a form which is used to report income, and we're using it to report an employer contribution in that year? Why would you do that? What makes the employer's contribution subject to tax?
It's a Roth contribution, so it has to be, it's going into a Roth IRA, so it has to be after tax.
Your tax.
Oh, wait a minute, wait a minute. Okay, all right, I see it now. The employer is not allowed to contribute to a Roth IRA. Only the employee can contribute. So if the employer contributes, that is immediate income to the taxpayer.
Yes, but they are allowed to now. The Secure 2.0 allowed them, the employer, to put the match into a SEP IRA Roth or a simple IRA Roth, whereas in the past they couldn't. So that employer contribution has to be taxable, but they're allowed to do it now.
Yeah. Now I see it, yeah. So the money actually is given to the individual, then recycled, except that it's all compressed into one transaction, and that's why you need the 1099-R, because there's an income tax consequence to what the employer is doing. Yeah. I hope I never see one, but I'm afraid I probably will.
Cool. Hopefully that elucidated the topic for a lot of people. Might be ambitious, but we got 2 minutes left if people want to continue on or not. But let's see if we can answer one last question. So we'll start with you, Bill. See if you can get it. But if you see a taxpayer or perhaps their employer made an inaccurate contribution to their retirement account, perhaps over contributing, or maybe still subjecting pre-tax contributions to tax, what are some ways that you found work best to get these corrected? Do you find working with the taxpayer works, or do you try to coach your clients on how they should notify their company to make these corrections?
I coach my client. I explain the situation and tell them, you tell the employer to stop doing that, or to cut back, or whatever must be done in order to comply with the law. That generally works.
Cool.
I never contact the employer unless the taxpayer authorizes the employer to contact me, but I'll never initiate the call. I think that's stepping out of bounds for me.
Anyone else have any thoughts or input on that? Or okay, guess not. But yeah, we've hit 3 o'clock now. I'd like to thank everyone for joining us for the first live event of the year, and I'd love to thank Mr. Delaney for joining us and everyone else for participating as well. But I thank you guys all, and I hope you guys have a wonderful and lovely day. All right, take
Thank
care,
you.
y'all.
I've enjoyed it.
Yeah,
Even when I was wrong, I still enjoyed it.
that's important here. It's very important, but
Thank you,
will-
Bill, truly.
Mhm.
You're very welcome.
Bye.